Every financial era has a moment when the story changes, not with a headline, but with a confession. Not with a crash, but with a quiet shift in tone from the institutions that once controlled the narrative. These moments rarely feel dramatic in real time. They feel confusing, disorienting, almost boring, until suddenly they aren't. What you're about to hear is not a prediction. It's not a theory. It's a chain reaction already in motion. And once you see it clearly, you'll understand why the rules that governed markets for decades no longer apply. Now let's step into the moment where the charts stopped speaking and the system started confessing. There are points in financial history when charts lose their authority, when indicators stop guiding and start lagging, when price action no longer asks a question, but delivers a sentence. We are standing in one of those moments. What's unfolding right now isn't volatility. It isn't a routine correction or a healthy reset of risk. This is structural failure. Slow at first, then sudden. The kind that only looks obvious after the fact, when portfolios are already damaged and explanations come too late. And today, one of the most powerful players in the Western financial system quietly admitted it. We are officially on red alert. Stop watching 5-minute candles. Stop fixating on RSI, MACD, or short-term noise. What's happening on January 6, 2026 is not a dip to be bought or a setup to be traded. This is not technical. This is conflict. And today, we received the first unmistakable signal that the Western Front is giving way. This story centers on Bank of America, not a small lender, not an online personality, not a fringe voice shouting from the sidelines. We're talking about one of the largest, most influential institutions in global finance, an institution that has spent decades openly hostile to precious metals. This is the bank that relentlessly shorted gold and silver, the bank that repeatedly warned clients to stay away from metals, the bank that dismissed gold as outdated and treated silver like a sideshow. For years, this institution functioned like the Death Star of finance. And this morning, its shields dropped. Bank of America has officially surrendered to reality. For years, they claimed gold was overpriced at $2,000. Now, in plain language, they've published a new average price target, $4,538 per ounce. Pause on that. That's not optimism. That's not bullish enthusiasm. That's an unspoken acknowledgement that the fiat system itself is under strain. Numbers like that don't exist in a healthy currency environment. But they didn't stop there. They went on to say gold should no longer be viewed as a speculative hedge, but as a foundational holding, recommending 20 to 30% of portfolios be allocated to gold. Understand how extreme that is. For decades, banks insisted on zero exposure, or maybe 5% at most. Jumping from 5 to 30% isn't portfolio tuning. It's alarm. It's an admission that the remaining 70%, stocks and bonds, is facing systemic danger. And yet the gold call wasn't the real revelation. Silver was. This is where the curtain finally lifted. After years of suppression, Bank of America finally ran calculations they had avoided for over a decade. They revisited historical ratios, they examined geological constraints, they confronted physical reality, and they concluded that silver is compressed, ready to unwind, not to $80, not to $100. Using the 2011 ratio, they project $135 silver. Using the 1980 ratio, the implication jumps to over $300 per ounce. Read that again. The same institution that helped restrain prices is now publishing research pointing to silver levels most investors can't even conceptualize. Why the sudden reversal? Not because they care about your returns, not because they want you positioned early, because they're cornered. They see the same fracture we do, only with deeper data. Paper suppression only works as long as physical metal exists somewhere in reserve, and now that reserve is disappearing. In the same report, they quietly acknowledge the supply breakdown. Global silver mine output is projected to fall another 2% this year. Even more damaging than declining production is rising cost pressure. Energy costs are higher, labor is higher, equipment is higher. At $70 silver, many mines were barely breaking even. At $300, production becomes viable again. Bank of America understands the price must rise, or the industrial economy simply runs out of metal. This isn't forecasting, it's repositioning. They want the historical record to show they saw it coming when prices accelerate vertically. And this moment, when the largest bear stops resisting and starts chasing, is what ends the first phase of every major bull market. Once that happens, sellers vanish. Only air remains above. But Bank of America isn't just watching mines and models. They're looking east, toward the real force draining the system, because their urgency makes no sense unless you understand what just ignited in Beijing. While Western media debates quarter-point rate moves and fractional inflation data, China has unleashed the largest liquidity expansion in recorded history. Not a stimulus package, not infrastructure spending. A monetary event so massive it bends global gravity. China has expanded its M2 money supply by 48 trillion yuan. To put that in perspective, that's roughly twice the entire M2 supply of the United States. Remember what happened when the US printed 5 or 6 trillion during the pandemic? Housing exploded, asset prices surged, purchasing power eroded. Now imagine a monetary event several times larger. But here's the critical difference. When the US prints, capital flows into stocks, derivatives, and financial engineering. China is doing the opposite. They're converting paper into physical assets rapidly. Oil, copper, food, and above all, gold and silver. This isn't economic stimulus. It's strategic conversion. China is executing the largest resource acquisition in modern history, trading newly created currency for materials that took geological ages to form, and the West is supplying them. This is the black hole effect. China has become a gravity well for precious metals. Price is irrelevant. If silver hits $85, they buy. If it hits $95, they buy again. They don't measure value in yuan, they measure it in ounces. Because whoever holds the ounces when the system resets controls the outcome. This is why premiums are exploding. This is why paper prices no longer reflect reality. Western markets set prices during Western hours, but physical flow is dictated by Eastern demand. And with 48 trillion yuan behind it, that demand doesn't slow. Every dip is absorbed, every pullback is consumed. A rising floor is being built beneath the market, day by day. China isn't trading for profit, they're trading for survival, and that exposes the fatal weakness of the Western system. While China is long resources, Western banks are short them, and the scale of that short position isn't risky, it's unworkable. Based on derivative exposure and participation data, Western banks are net short roughly 4.4 billion ounces of silver. Let's anchor that to reality. Global silver production is about 800 million ounces per year. That means banks have sold, on paper, more than 5 times annual global supply. They're short 550% of the world's production. There is no historical precedent for this. They sold at $20. They sold at $25. They sold promises backed by metal that never existed, assuming they could always push prices lower later. They didn't factor in China. They didn't factor in industrial demand. They didn't factor in physical limits. Now, every $1 rise in silver cost them $4.4 billion. At triple-digit prices, losses aren't uncomfortable. They're fatal. But money isn't the real issue. Delivery is. These aren't speculators asking for cash settlements. These are governments, defense contractors, and industrial systems that require metal, not promises. And when delivery is demanded on billions of ounces that don't exist, the system fractures. This is the margin call that ends manipulation. Banks will be forced to buy into a void. No supply, no sellers, only rising bids. This is how prices go vertical. This is how charts gap. This is how $300 doesn't take years, but days. Which brings us to the final illusion. The banks know they're trapped, so their last weapon is psychology. They need your silver. They want $80 to feel expensive. They want you to believe the move is finished. It isn't. The market has split in two. And the gap between the number on your screen and the value in your hand has never been wider. Let's strip this down to the truth, because this is exactly where most people lose the plot. If you can't separate the number glowing on your screen from what's actually happening in the real market, you're walking blind into a slaughterhouse. This is the oldest illusion in finance, and it works every cycle because people mistake paper quotes for real value. That's why we have to confront the paper versus physical split, and why $80 silver is not a win. It's a snare. Right now, you open your trading app. Silver is screaming higher, green candles stack up, headlines shout $80 an ounce. I see the reactions, I see the celebration, people congratulating each other saying, "We did it, we're rich, stop, seriously, stop." Because that number is not silver's value, it's the price of a paper contract traded in a futures pit. And let me be absolutely clear, $80 for physical silver is garbage paper. It isn't fair, it isn't honest, and it certainly isn't real. It's a managed number designed to shake metal out of your hands before the real move begins. So here's the real-world test. Ignore the chart, trust the market. Pick up your phone, call your local coin shop, call the big online dealers. Ask them to sell you a 1-ounce silver eagle at $80. Ask for a 10-ounce bar at spot. You'll hear laughter on the other end. You'll be told there's no inventory at that price. You'll be quoted the real price, the price required to actually hold silver in your hand. $90, $95, sometimes already north of $100. That spread isn't random. That spread is the break. That's the exact moment when paper detaches from physical reality. Banks are pinning the paper price near $80 with algorithms and high-frequency trading because that's the level where their losses are still survivable. They want $80 to feel generous. They want you to sell your stack back into the system so they can recycle your metal to patch their 4.4 billion ounce short position. This is a liquidity hunt, a shiny number dangled in front of you, hoping instinct kicks in. If you sell physical silver at $80, you're handing over a winning lottery ticket for pocket change. You're giving up the one asset that shields you from the $48 trillion monetary flood coming out of China. Look at the premiums. In a normal market, premiums are trivial, $2, maybe $3. Today they're $10, $15, even $20 above spot. That's your signal that the spot price is broken. If the paper price were legitimate, arbitrage traders would step in, take delivery, and close the gap. The fact that they can't tells you everything you need to know. The contract is hollow. The screen says $80, but the vaults say not enough metal. This is why major banks suddenly started talking about triple-digit silver. They know the illusion can't hold. Eventually, the futures market freezes, cash settles, or collapses, and when that happens, only the physical price survives. And that price doesn't crawl upward. It snaps higher. It gaps. We've seen this movie before, in nickel, in palladium. When physical shortages become undeniable, price doesn't negotiate. It explodes. So don't let green candles trick you into thinking the squeeze is over. It hasn't even begun. What you're watching now is the warm-up, one last attempt to shake metal loose through boredom, fear, or greed. But think like the players who actually understand power. Does China sell when prices rise? No, they buy faster. Does the military sell when prices rise? No, they stockpile. So why would you sell? You're holding the collateral of the next monetary order. You're holding a core input for energy, defense, and industry. You're holding wealth with no counterparty risk. And the most powerful institutions on the planet are trying to pry it from your hands. The $80 trap is their tool. Don't step into it. If you sell now, you won't get a second chance. You'll look back at January 6, 2026 and realize it was the last time silver traded below 3 digits. You'll understand that $80 wasn't the peak. It was the bargain of a lifetime. Now we reach the final countdown. Even if banks wanted to close their 4.4 billion ounce short, even if they printed unlimited money, they've hit a wall no financial trick can breach: the supply cliff. Buried inside the same bullish reports was a chilling admission. Global silver mine production is set to fall another 2% this year. That sounds small until you understand commodities. A 2% drop in supply during a demand surge isn't a shortage. It's starvation. Inventory drains daily. And here's the lesson. Wall Street is learning too late. Price doesn't create supply. Mines aren't factories. You can't flip a switch. If silver hits $100 tomorrow, next week's production increase is zero. Discovering, permitting, and building a mine takes a decade. For years to come, we're locked into the supply we already have, and that supply is degrading fast. High-grade deposits are gone, ore grades are collapsing. Where miners once extracted 15 ounces per ton, now they're lucky to get 4, more rock, more energy, more cost. It gets worse. Nearly 70% of silver is produced as a byproduct of copper, lead, and zinc mining. If the global economy slows and base metal operations shut down, silver output vanishes instantly, right as demand from solar, defense, and investment surges. That's the perfect storm, a structural geological shortage that no amount of money can fix. This is why the banks folded. They checked the charts, they checked the vaults, then they checked the mines, and realized there is no rescue coming. No supply wave, no relief, so they switched sides. Now it's on you. You've seen the surrender, you've seen China's liquidity bomb, you've run the short squeeze math, you've recognized the fake price. You've stared at the geological wall. Every signal, technical, fundamental, geopolitical, is aligned. Not up like a stock rally, but up like a reset of value itself. Analysis time is over. Hesitation time is over. This is execution. The window is narrowing by the hour. Asian markets are opening. Premiums are climbing. Inventory is disappearing. So here's the final directive. Don't sell, don't flinch, don't exchange real wealth for decaying promises. If you can still find metal, buy it. Pay the premium, buy scrap, buy what others overlook, because soon the question won't be, what's the price? It will be, is there any left? And the answer will be no. The banks gave you the target, China gave you the catalyst, geology gave you the certainty. The alert is read, the line is held, the outcome is decided.